Soni, Advocate Ramesh Trivedi, Advocate Praful Shah, Advocate Bharat Jain, Advocate Rupesh Shah, and Advocate Nitin Vadodaria to kindly come near the dais. Real welcome to everyone present here to the fifth technical session to be delivered by Advocate Dhinal Shah sir on TDS provisions for payments to non-residents and TDS versus TCS interplay for residents transaction. Sir, we welcome you on the dais. We are pleased to have Advocate Dhinal Shah sir amongst us. Sir is a partner of Ernst & Young Tax and Regulatory Service Practice. He is a chartered accountant. He is a chartered accountant and lawyer by qualification and has more than 25 years of experience in advising clients on taxation, exchange control, and regulatory issues. Sir is an executive committee member of International Fiscal Association and secretary of ITAT Bar Association, Ahmedabad. Sir was also a Central Council member of the Institute of Chartered Accountants of India, director of IPA and RVO formed by ICAI, and was chairman of Direct Tax Committee of Gujarat Chamber of Commerce and Industries. He has also addressed and presented papers at various seminars and conferences. Sir is also a regular contributor of articles to the Institute and other professional journals and has co-authored a book too. I extend a formal welcome to Advocate Dhinal Shah sir, and I request Advocate Ramesh Trivedi to welcome sir with a book. A big round of applause for sir. I now request Advocate Bharat Jani to welcome sir with a memento. Thank you so much, sir. I now request Advocate Dhinal Shah sir to please come forward and address the gathering.
Let me first thank All Gujarat Federation and IT Bar for giving me this opportunity to relearn TDS TCS. Rupesh, Ramesh bhai, Bharat kaka, Praful bhai, other senior members of the profession and dear friends. When she was just introducing and she also referred to me as partner of EY, it is not her fault, it was my fault that I did not share the updated version similar to the glitches on the 26AS portal where every day you have a change and the government does not change the thematic and the portal features in a more timely manner. So it was not your fault. Let me first take up TDS and TCS interplay, and then I will go back to certain nuances of non-resident TDS, and there are 4 or 5 issues which every one of us must take care. Particularly when you obtain a certification from a chartered accountant under 15 CB, there are certain obligations which all of us have as a professional. We had 2 provisions which was introduced simultaneously by Finance Act 2020 of TDS on e-commerce operators, section 194 capital O, and section 206C1H, TCS on the sale of goods. Now, before this section, TCS was always applicable on certain items like scrap, like timber, like alcohol, like motor vehicle. But that items were very, very few, and it was only applicable to a very few select class of people. And therefore, normally the TCS was not given much importance. But then government wanted to track the transactions on purchase and sale of goods. And one of the reasons which I understand informally from the government is that they wanted to track this transaction more particularly from a GST perspective rather than from an income tax perspective. Because there were concerns about bogus credits menace in the market, and government wanted to control these transactions so that ultimately they can track the purchase and sale of goods, and therefore the rate is as low as 0.1%. Exactly 4 months after the 1st October 2020, when the law was introduced on TCS and on 194 capital O, the new section 194 capital Q was introduced on the TDS about again 0.1% from 1st of July 2021. Now the first question which everybody arose was that how do I comply TDS and TCS? One is from a buyer perspective and one is from a seller perspective. One is on creditor payment, whichever is earlier, which is a normal provision, whereas under TCS, it is a sales realization. And it has nothing to do with purchase or sale of goods or an accounting issue. It was more from a realization perspective. So even if I would have sold goods prior to 1st October 20, but if I would have realized amount which is more than 50 lakhs after 1st October 20, then the TCS would become applicable. Whereas TDS was on payment or credit, whichever is earlier, which is similar to any other sections. The circular of 30th June 21 or the guidelines clarifies, which is also given in 194Q, that these provisions will override the provisions under other sections, including particularly 206C1H. In other words, and that is also clarified in the guidelines, to say that if you have a TDS obligation from a buyer, then there is no need to do a TCS from a seller. But then the language is slightly complicated, including in the 2 different questions of the circular. If for any reason the buyer does not deduct TDS under 194Q, is there an automatic obligation under 2061CH of doing a TCS? Or the seller can always presume that it was an obligation of the buyer to deduct TDS, and therefore there is no obligation on me to do a TCS. In one of the line of the circular says that if he does not deduct or if he fails to deduct, then it is an obligation of the TCS for on the seller side. So in other words, ideally the situation would be that the seller would always have to track or at least take a declaration from a buyer that I am not subject to a TDS provisions, and therefore if TCS is applicable to you, please go ahead and do a TCS. And therefore this one declaration would help at least particularly a seller to comply the law under the TCS provisions. The second challenge is that both the law says that if the amount should exceed 50 lakhs and the turnover of the buyer or seller should be more than 10 crores from a business activity. And then there is a clarification both of September 20 and June 21 that the transactions which are subject to conducted on the stock exchange, which is a listed securities or the commodities or the electricity duty, those transactions are not subject to TDS and TCS. So one question would arise that if I sell my shares off market worth 15 crore in the current year, in the next year I do another transaction of, say for example, of 1 crore, whether a TDS or a TCS provision would trigger. Now, if you go back to the Sale of Goods Act, including the GST Act, the word goods includes securities. And if I go by that interpretation of goods, then to the extent of transaction of a purchase or a sale of a securities which are not on the recognized stock exchange or which are not under the GIFT City IFSC, then in those cases both TDS and TCS provision would get triggered. My personal view that if I am not carrying on the business in securities, I am not a trader of a securities, even if I am doing a transaction off market which is not on a recognized stock exchange, because in both the circular one thing is made very clear, that you have to take a turnover only from a business activity, you should not take the turnover from other activities. And therefore, if my last year turnover was 9 crore, but I have a capital gain or a turnover of sale of shares of another 12 crores, total is 21, my personal view would be that I am not subject to TDS or TCS provision because my transaction from a business activity or a gross turnover or a gross sale from a business activity does not exceed 10 crores. But I know in market, everybody as usual plays conservative. And they say that what is a loss in deducting a TDS at 0.1%. And therefore people do TDS, particularly when you go to a large transactions and when you meet law firms, they take extra conservative view to say that even you should deduct TDS on securities because clarification is only in relation to securities conduct transacted on the recognized stock exchange. Which my personal view is not required because it is not from a business activity. That is what even government accepts in 30th June circular. Similarly, I have interest income. Similarly, I have a rent income. All such income which is not a part of my business turnover, which we would believe all of us as a part of a tax audit, that if it is not subject to a tax audit, because today section 44AB limit is also 10 crores. And therefore, if I am not subject to tax audit, which has been accepted by department that yes, you are not subject to tax audit because it is not a business income, then I would believe that that should not impact the non-compliance of TDS or the TCS. The second issue, how do I do interplay between an e-commerce operator, because there also it is a purchase and sale of goods on the platform. Similarly, this is a physical goods and not on the digital platform. If you read section 194 capital O, it starts with notwithstanding anything contained in part B of chapter 17B. In other words, the entire part B in relation to TDS starting from 192 is overruled by the first line of the subsection 1 to say that the e-commerce operator TDS would apply irrespective of what is provided in the other sections of in relation to the TDS. Secondly, it also applies to sale of goods and services. So it is not only sale of goods, it also extends to services. And then subsection 3 clarifies that if the sale of goods and services are in relation to an e-commerce operator transaction, then you will be governed by 194O. But if it is not in connection with e-commerce operator transaction, then you will be governed by normal transactions. See, if I am paying a fees to a chartered accountant or an advocate or a lawyer, then I would be still governed by 194J. But if I am paying fees through an e-commerce operator transaction as e-commerce participant on purchase and sale of goods, then I would be governed by 194O and not 194J. And these services similar to what you pay to Zomato or what you pay to Swiggy, which is similar to your e-commerce operator transactions, which is a common platform. The only thing is that there, as an individual and HUF, you are given an exemption up to Rs 5 lakhs. But These 5 lakhs along with a condition that each e-commerce participant should furnish PAN or Aadhaar. So if as an individual I furnish my PAN and Aadhaar, and if my transaction is less than 5 lakhs, then 194O does not apply. But otherwise, for non-individual and partnership firms, the limit is 0, and for all other taxpayers, the limit starts from rupee 1. So when you go to 194O and 194Q, if the transactions are on digital platform, so if I go and buy on Amazon, if I go and buy a Flipkart, then it will be subject to 194 capital O. If it is not subject to 194 capital O, then I will be governed by 194 capital Q. For the purpose of TDS, the limits are completely different. The rate of TDS is also completely different. Under 194O, it is 1%. Here it is 0.1%. The third thing, which is again clarified somewhere in the circular, that what happens to our non-resident transactions. As far as TCS is concerned, the law itself excludes export of transactions. So any export of goods is completely excluded. Similarly, the buyer excludes import of transactions. And therefore, the definition of the buyer also excludes import. What happens to the TDS provisions? So if I export the goods, the non-resident is a buyer, is he required to deduct TDS under 194 capital Q? Extreme hyper-technical view if somebody wants to take, the answer should be yes, but legally and in practice, and if you align with other provisions of the section, including 206AA, 206AB, 206CB, everything if you look at it, it excludes the non-resident transactions. Because ultimately the law does not apply to a non-resident who does not have a business connection or permanent establishment in India. And therefore that also should not be applicable as far as the non-residents are concerned. The second situation, which is again clarified somewhere in the circular, is what happens to a TCS provisions which is also applicable to other class of transaction. And the example which is given is in relation to a motor vehicle which is under subsection 1 capital F. In case of a motor vehicle, we already have a TCS provision to say that if you sell car from a dealer and if the amount of motor vehicle is more than 10 lakhs, then the dealer has to do a TCS as far as sale of car is concerned and deposit with the government. What happens between the TCS under 1H and the TCS under 1F? The law clarifies, including supported by a circular, to say that wherever 1F applies, you don't do 1H, but wherever 1F does not apply, you have to do 1H. In other words, whether it is a B2B transactions or whether it is a B2C transaction, if the 1F does not apply, then 1H will apply. And if the turnover of the seller is more than 10 crore last year and the transaction value is more than 50 lakhs, then the 1H would apply. The third thing is that when you do a transactions, there could be purchase returns, there could be sales returns, there could be credit notes, there could be many other things which are applicable in relation to our transactions. How do you account for as far as the TDS and TCS are concerned? So I sell goods worth 100 rupees. I levy a GST of 12%. After 15 days, I give him a credit note of 10 rupees. And therefore, ultimately, he will pay me 90 plus GST. Do I do a TDS on 100 or on 90? Or what do I do as far as TCS is concerned? Now, as far as TDS is concerned, the law, similar to any other provisions of the TDS, is any amount credited or paid whichever is earlier. So when I credit 100 rupees in my books of accounts, say for example on 5th of March 2022, my liability to pay TDS will arise by 7th of April 2022. I have to do TDS on 100 rupees. But before 31st March 22, if I already given a credit note of 10 rupees and the amount is reduced to 90, then I can do a TDS on 90, and then I will pay on 90 at 0.1% by 7th of April 22. But as far as TCS is concerned, it is only on the realization of the amount, and therefore it has nothing to do with your TCS or credit notes or debit notes or purchase return or sales return. Any adjustment to the sale price has nothing to do as far as TCS is concerned, because it is only on the realization of the amount from the buyer and not on the amount credited or paid, whichever is earlier. The only challenge that as far as TDS is concerned, the government, similar to 2017 circular, clarifies that the GST will not be a part of, for the purpose of gross amount, for the purpose of TDS. So if the amount of invoice is 100, 12 is the GST, I have to do TDS on 100. But when I pay to a seller 112, he will do TCS on 112 and not on 100. This will create a huge mismatch in your 26 years return, because GST is a balance sheet item. You will credit and debit, use the credit as far as payment is concerned, whereas when you do a TCS, it will be 0.1% on the realization, and that will create a mismatch between 26 years and your TCS liability. And again, you will have to reconcile all these figures as far as the realization is concerned. The last issue, as far as the e-commerce operators and the TDS TCS, is about the limits up to which you have to do. So every time you have to see that, am I subject to a TDS provisions because my turnover was more than 10 crore last year? If answer is yes, I will go back to a second condition, that is my transaction is more than 50 lakhs. If my transaction is more than 50 lakhs, then I will do a TDS. Hypothetically, my transaction is only 40 lakhs. Though I have crossed the first limit of turnover more than 10 crores. Since my transaction is less than 50 lakhs, the obligation will go on the seller to do a TCS. Now, as far as TCS is concerned, what happens? That his turnover is more than 10 crores. For the last year, he would have received 20 lakhs, and in the current year, he would receive 40 lakhs because it is on realization. So, though my transaction of the current year is less than 50 lakhs, but since it is on collection of the amount, last year of 20 lakhs, current year of 40 lakhs, he will cross the second limit of 50 lakhs, and therefore he will have to do TCS. The person who is buying the goods may not be required to do a TDS, because during the year transaction is only 40 lakhs and does not cross 50 lakhs. So one will have to track these limits from a buyer and seller perspective on a periodical basis, and to ensure that am I complying the law from the time to time perspective. Let me go back to our non-residents. There are 5 issues which I wanted to discuss in a more simplistic way rather than going to the jargons of law. Last year, not last year exactly, but in 2020 Act, Section 6, Capital 1A was introduced, which provides that if I am a citizen of India and if my income is not, and I stay outside India, and my income is not liable to tax outside India, then I will be deemed to be a resident for the purpose of Indian taxation. And then there was an amendment in 6.6 to provide that if I fulfill condition of 6.1a, then I would be treated as resident but not ordinarily resident. So let me take a simple example. I am a citizen of India. I stay in UAE for last 25 years. I come to India hardly for 30 days in a year. And therefore, by virtue of Section 6.1, I am a non-resident. But when I go to 1A, I am a citizen of India. Answer is yes. Am I liable to tax in UAE? Answer is no, because UAE does not levy income tax. The definition of liable to tax has also been introduced in the Finance Bill of 21. And therefore I am not liable to tax in UAE, and therefore I become a resident of India for the purpose of section 61A, though I stay in Dubai for last 25 years and I hardly come to India just because I am a citizen of India. And then the 61A says that I should have income in India more than 15 lakhs. If my income is less than 15 lakhs, even if I am a citizen, I will continue to be a non-resident. But then 66 says that I will be treated as resident but not ordinarily resident. Now, as far as resident but not ordinary resident is concerned, my foreign income is not taxable in India except a business or profession which is controlled from the foreign country which is based in India. So what is a practical challenge which people are facing? That wherever I am outside India, but I continue to hold citizenship of India, I have an income more than 15 lakhs in India, I have a business activities in India, those activities may get taxed from the purpose of section 61A and subsection 6 read with 6 read together. In other words, one will have to take care as far as the non-residents are concerned who are having a citizenship of India but who are based out of countries where there is no levy of individual taxation. Today, I would believe that 90% of the countries do levy income tax on per individual. The UAE has also announced a levy of tax from 1st July 2023, but only on the corporates, not on the individuals. And therefore, maybe after a few years the situation will change. But today, if I am a citizen of India and if I am situated in a country where I do not pay tax, then one will have to take care as far as the residential status and the disclosure of income is concerned. The second challenge, there is a concept which was introduced in the section 9.1, which is called significant economic presence, SEP. Now, simple words is that if there is a non-resident, if a non-resident sells goods to India more than rupees 2 crores, not to me individually, he can sell to all of us, but the total amount of sales is more than 2 crores, then it is deemed that he has a business connection in India. In other words, his income from this sale of goods to Indian resident attributable to income, it could be 1%, it could be 5%, it could be 10%, is taxable in India. If it is get taxable in India, then when I make a payment to him and when I issue 15CA, 15CB, since it is a business income, I have to actually do a TDS at 40% plus surcharge plus education. But in all the tax treaties which India has entered into with majority of the countries, this SEP concept is not introduced into a tax treaty. So wherever I import goods from a country where India has a tax treaty, this condition still does not apply. And therefore, I don't have to do a TDS. On this situation, I have to do a TDS if amount is more than 2 crores. But in the treaty, I don't have to do a TDS. So hypothetically, I purchase goods from a Cayman Island, which is a tax haven, so-called a tax haven country, where India does not have a tax treaty. I will have to govern by these provisions that if I purchase 2 crores and when I make payment to him, I have to do a TDS at 40% plus surcharge, unless I go to a tax department and get a lower withholding certificate under 197(1) or 195(2). For a treaty, there is no taxation, there is no TDS liability, but the law says that when you take advantage of a treaty, because income is not taxable in India, you must need tax residency certificate of the seller and a declaration in form number 10F under Rule 37BC. If these two documents are available, then you can take a benefit of a tax treaty. Now in practice, majority of the cases you have a single transaction of import. You may not have much deeper relationship with the supplier. He may be coming from a certain countries where TRC has not issued easily. I know countries like Bangladesh, countries like Ethiopia, they do not issue TRC very easily. And therefore, even if I have a treaty with Ethiopia, even if this income is not taxable in India, but if I do not have a TRC, I do not have a 10F declaration, then I will have to go back to this law, and then the question would arise about deduction of a TDS on payment to a non-resident. This law came into force from 1st April 21. So it is applicable for 21-22. The notification of 2 crore was issued on 3rd May 21. And therefore from 3rd May 21, everybody is aware about a 2 crore limits as far as the purchase of goods are concerned. And therefore, you must take appropriate care wherever you have a clients importing the goods more than rupees 2 crore, which is in my opinion is a very, very small threshold. And wherever you have a treaty situation or a non-treaty situation, you must take care so that at least you are not into 201 proceedings tomorrow. There is a judgment of an Ahmedabad tribunal in SCAPS India, where the tribunal has taken a view that even if there is no TRC, but if there is some evidence about that he is a resident of that country for tax purpose, like for example acknowledgement of income, if he submits that, then also that could be a sufficient evidence. Ideally it is TRC, but if TRC is not possible, then some other document which could demonstrate that he is a resident of the other country, that also should be sufficient as far as the compliance of the treaty and the benefit of the treaty is concerned. The third point is about technical services versus standard services. You go to pathology lab and you pay testing charges for RT-PCR and the amount exceeds 30,000 in a year. Do you deduct TDS under 194J? You pay to Vodafone, Bharti, BSNL, Jio, mobile charges. Do you do TDS on these charges if the limit exceeds under 194J? In all Surat, you pay grading reports charges to gemological institutes in different countries, which could be in Botswana, which could be in Thailand, which could be in many other countries. And you pay these grading charges similar to your ISI mark, that you get your ISI mark on the goods and you pay these ISI charges. Do you deduct TDS on these charges? Answer is no. And why? Section 917, which is also there in 194J, and now 194J says 2% and 10%, technical is 2, professional is 10. Now what is technical and what is professional, I don't know. So, but 2 and 10 is there. The 917 says that any payment which is of the managerial nature, technical nature or a consultancy services, it is taxable in India under 917, particularly to a non-resident. But the same definition is borrowed for the purpose of 194J. Now the question is that when I make these pathology lab reports or grading charges reports on a diamond business or an ISI mark charges or the mobile charges, or say for example to a aviation company for going from India to America and I pay 2 lakhs rupees of ticket charges, do I deduct TDS on that because I am using an aeroplane which is highly sophisticated equipment? In all these, answer is no. And the reason we have an old judgment of Madras High Court 251 ITR Skycell Communications. The Madras High Court 20 years back has taken a view that any payment which you make, which is a standard services, which is available to all of us, which is not tailor-made for you and me, then it is not a technical services. So when I go to a Sterling Accuracy or a Supratech for a Corona RT-PCR, he is doing what he is doing for all of us together. He is not doing a separate report for me. If I take a blood report or if I take a cardiogram or any other reports, it is a standard facility which is available to all of us as patient. Similar to a mobile charges, similar to an aviation charges, similar to ISI mark, similar to a grading report for diamond business. And therefore, it is a standard services and therefore it does not fall into 917. There was a huge disputes on this in case of a Kotak Securities judgment. All of us, or majority of us, do online trading on the stock exchange. You have a password, you log into a Kotak Securities login account, you get login to NSE, BSE, and then you do an online trading. You pay user charges of NSE, BSE. So Kotak Securities was paying these user charges to NSE, BSE for the purpose of using this online platform facility. The question was that whether it is a technical services. Unfortunately, the Bombay High Court said yes, it is a technical services. And therefore you must deduct TDS on this amount. The matter travelled to Supreme Court. And Supreme Court, in very categorical and very fine judgment, said that this is a standard services which you get from NSE, BSE. If any one of us can log in, pay the charges and do our trading, unless it is a tailor-made services to the needs of the recipient of the services, it is not a technical services. It is a facility which is available to all of us in a standard category. And therefore, this is not a technical services. TDS is not required to be deducted. And if I follow the same principle to all these examples which I gave, the TDS is not required to be deducted as far as the standard facility is concerned, unless it is a tailor-made to a requirement of a particular recipient of the services. This is one thing which comes day in, day out in the 201 proceedings. That why have you not deducted TDS? Because one of the argument under 917 is that services should be utilized in India. The next is software. When I buy a software, say for example a Tally software or a Microsoft 2000 edition or Adobe Acrobat, do I need to do a TDS? Section 916 on royalty, read with explanation 4, which was inserted retrospectively from July 76, that any payment towards software is deemed to be a royalty for the purpose of Income Tax Act. And the 916 is also referred in 194J. So even if you make a domestic payment for purchase of a software which exceeds the threshold under 194J, then there is an obligation to do a TDS. Except there is a notification which was issued that if there is a resale of software products from one person to another, to avoid cascading effect, the one person who has already done a TDS can give a declaration, so subsequent people do not have to do a TDS. But subject to that notification, the software is a royalty for the purpose of Income Tax Act. Similarly, I buy from Microsoft Singapore, I buy from Microsoft US, a softwares in day to day. Today, entire world is on technology. And therefore, I buy softwares in, day out. Because if you see section 1916 royalty definition, in the bracketed portion they uses the word granting of a license. that word granting of a license is creating a challenge. Because when you buy a Microsoft 2000 or when you buy Adobe, they don't give you an ownership rights, they only give you a license to use. And therefore, there is a terminology which is used in the professional world, is called what is called copyright versus copyrighted article. When I buy a Taxman book after the budget, what I am buying is a copyrighted article and not a copyright. Because otherwise, when I buy a Taxman book or a Chaturvedi book or a Ramaiah book under Companies Act, I have to also do a TDS on that. But that is not a copyright, because Mrudang cannot buy one income tax that give you free of charge Xerox charges. Otherwise, he will be violating a copyright act. And therefore, what he's buying is a book or an article and not a copyright. The issue came before Supreme Court. A landmark judgment in the case of Engineering Analysis Equipments Private Limited. The Supreme Court said that as far as treaties are concerned, so this judgment is only applicable when you make a payment to a non-resident for buying a standard software. So if I buy a Microsoft 2000, if I buy Adobe Acrobat, or if I buy any other softwares from a non-resident, and when I make payment to him, then the Supreme Court said it is a standard software, it's a copyrighted article, it is not a copyright, because under section 14 of the Copyright Act, the law says that if you buy a copyright, I am allowed to do copy within my organization at my home and commercially exploit that. But I don't have that commercial right to exploit. I don't have a right to copy for the purpose of larger mass of the people, and therefore what I am buying is only an article and not a copyright. And therefore, the Supreme Court said that if you buy a standard software, which is again a terminology people use, off-the-shelf software. So if I buy off-the-shelf software, if I buy standard software, or if I buy a software along with hardware, so when I buy a laptop of a Dell or an HP, there are certain standard software already uploaded into a system, and I don't pay separately for those softwares. For all these situations, I am not required to do a TDS because it is not a royalty, because I am not paying for the purpose of copyright. I am only paying for a purchase of an article, and therefore I am not required to do TDS under Article 12 of the tax treaty with majority of the countries. And therefore, this principle will hold good, as I told you, is only for non-resident payment and not as far as the domestic payments are concerned, subject to that resale notification to avoid a cascading effect on the purchase of a software. Otherwise, all software payments are now treated as royalty for the purpose of TDS. Only last observation on this is that we must understand that there is a distinction between buying a software and getting a software developed through a third party. If I enter into a contract with an ERP supplier that please help me to develop a manufacturing software, this software, another software, then it is not a standard off-the-shelf software. It is a tailor-made software only designed for my requirement, and therefore again going by Kotak judgment, it is a technical services, and therefore I will have to deduct TDS under 194J if it is a domestic payment. If it is a non-resident payment, I will be governed by 917, subject to our tax treaty obligations. So every software is not subject to TDS. Certain services which are tailor-made, like for example, I go and buy a SAP. SAP, there are certain tailor-made designing, tailor-made modifications which I make. In all those situations, I may have to do TDS because it is a technical services, it is not off-the-shelf software, and therefore I am not governed by the Supreme Court judgment of engineering analysis. The next is your digital payments. So for digital payments, there are two different situations. Situation number one, where I put advertisement on a digital platform. I go to Google, I go to Yahoo, I go to Flipkart, I go to different platforms and say, please put my advertisement on your platform. And whenever somebody does a search on Google, my advertisement should get reflected as a dealer or a service provider for this particular activity. There is an old judgment of a Calcutta tribunal in Right Florist. The Calcutta bench said that this advertisement is a business income, it is not a royalty, it is not a technical services, TDS is not required unless a non-resident has a business connection in India. To overcome this judgment and to introduce what is called equalization levy, there is a Finance Act of 2016, section 165. The law says that if I am a resident and if I make a payment more than rupees 1 lakh to a non-resident for advertising or related services in relation to advertising, like for example designing of an advertising, drafting of an advertisement or any other things in relation to that advertisement, the non-resident has to pay equalization levy of 6% to the government. This 6% ideally is required to be paid by a non-resident. In business and in commercial terms, it is always passed on a cost to the resident, and therefore ultimately resident will do a gross up, will pay to the government, and the non-resident gets amount without any tax. But this 6% is there on law since 2016. So wherever your client are putting an online advertisement, you have an obligation to comply equalization levy under section 165 of Finance Act 16. The question is, if there is already an equalization levy, do I still apply section 9 provisions? And the law says section 10 subsection 50 exempts income from chargeability in India. So once it is subject to equalization levy, it is not subject to the income chargeable under section 9 read with section 90 under section 10 clause 50. Finance Act 2020 further expanded the scope of equalization levy by inserting section 165 capital A to provide that if there is an online purchase of sale and goods, then also there will be an equalization levy of 2% on the non-resident. And similar to Finance Act 2016 equalization levy, this equalization levy, once it is levied, then there is no need to pay a TDS because it is exempt under section 1050. Now this Finance Act 2020 online sale of goods and services is very, very sensitive and critical. There was a clarification introduced in Finance Act 21. What is online sale of goods and services? And one of the condition is that even if I make online payment to a supplier, then also it is called online sale of goods and services. My personal view, that is not an intention or an objective, but as the law stands today, somebody can interpret this in absurdity. Basically, government wants to capture that rather than physical movement of goods, when you buy online purchase and sale of goods, you buy goods through internet, you buy goods through an e-commerce platform, you buy goods through different method on digital, or you take services. Yesterday night I was seeing some agreement where certain artificial intelligence services are given online. All these will fall into online sale of goods and services, and a non-resident has to pay 2% equalization levy on this amount. Commercially, it can pass on a cost to a resident, but ultimately it's a commercial decision between the two. But if the non-resident pays this 2%, then the resident does not have an obligation to do TDS because you can't levy tax twice on the same transaction. One is TDS and one is equalization levy. The next issue. कितना टाइम 10 मिनट The next issue is on obligation of 15 CA, 15 CB. Oh, before that, let me go to property transactions. Section 194 capital IA only applies when I buy a property from a resident. What happens when I buy a property from a non-resident? Now, that's a law, but before that, how do I ascertain that he's a resident or a non-resident? Because in 8 out of 10 cases, he will give you his Aadhaar card, he will give you his PAN, he will give you his passport, which is Indian, and therefore he will say he's a resident of India. Now, from a buyer perspective, I would believe that if a seller does not disclose his correct status, and he furnishes his Aadhaar, he furnishes his PAN, he furnishes his passport, and if I do TDS under 194 capital IA, then I would believe that at least I should not be held up for a non-compliance, because I have done a TDS, he disclosed that he is a resident, and therefore I complied 194 IA. But I presume that in 2 cases out of 10, he discloses his correct status and identity, that I am a non-resident. Am I required to do TDS under section 195? Because if I make a payment to a non-resident, 194 IA does not apply. It will only apply section 195. Now 195 only provides income should be chargeable to tax in India. And therefore, whether a capital gain arising from this property is chargeable to tax in India, the answer is yes, both under section 911 and also with the tax treaty with any other country, because in almost all treaties, the capital gain would be chargeable where the immovable property is situated. And if the immovable property is situated in India, then the capital gain would be chargeable. So the next question will arise that how do I do a TDS at what percentage? The capital gain tax for an immovable property is 20% plus surcharge. If I hold property for more than 24 months, it is long term. It is less than 24 months, it is short term. Now, there are 2 or 3 different options available. Option 1, that I do not know his cost of acquisition. I do not know what is his FME on 1st April 2001. Whether it is right, whether it is wrong, I don't want to go into this. And therefore, I will do TDS at 20% on the gross amount. Let him file the tax return and let him get the refund from an income tax department. So that's option 1. Option 2, that I go to a chartered accountant and say, please help me to calculate capital gain. He will calculate the capital gain. He will take either a cost or an FME as on 1st April 2001, do the indexation, calculate the capital gain and say that my capital gain is only 45 lakhs. I am going to invest into 54 EC bonds and therefore don't do TDS. Or if it is 1 crore capital gain, you only do TDS on 50 lakhs because I am going to invest 50 lakhs in EC bonds. The third option is going to a tax department under 197(1) and to say that please help me to calculate a capital gain tax liability. Please issue a certificate on what portion of the capital gain I need to pay tax, and I will pay TDS accordingly. Now in practice, all the 3 options are prevalent. I have seen all the 3 options people follow in different situations. Ideally and conservatively, the option 3 is the safest option. Because I have a certificate under 197.1, so I don't have to bother tomorrow. Option 1 is also a safe option because I am doing TDS on a gross amount. I am not worried about, or I don't care what happens to him on the capital gain or the refund portion. But on option 2, I have a risk. Risk is of one or two perspectives. One, the seller would say, I will invest into bond. Tomorrow he does not invest into bond. Or he invests after 6 months. Or his fair market value was not right. The report was not right. And therefore, ultimately, I am relying on somebody, some document. So, option 2 is a bit risky option. Today, my personal experience is the department is also very quick on such transaction. And if you furnish all the documents, maybe in a week or 10 days time, they issue 197.1. So you should budget this time of 15 days or 1 month time between a transaction and a TDS. But ideally, I would believe that option 3 would be a preferred option compared to option 1. I am not saying that it is a bad option, but it's a absurd option that you are deducting TDS at 20% of the gross in the absence of information. But if you want to close the transaction tomorrow, you don't want to go with option 2 and 3, then the only option left is option 1 and to do on the gross amount. But I have seen department issuing notices under 201 based on the registrar of properties information that so-and-so transactions have happened, so-and-so was a non-resident, and therefore they have started issuing notices for non-deduction of TDS under 201. It may not have impact on your 40A1 or anything, but 201 proceedings are still non-complied, and therefore you will have to match with a 201 proceedings. The next situation is on the obligation under 15CA, 15CB. Now, as a chartered accountant, whenever a client comes for issuing a certificate under 15CB, so if you see 15CB, there are 4 parts, A, B, C, D. Part A, where the transaction is less than 5 lakhs. Part B, you have 197.1 or 195.2 certificates. Part C, you actually deduct TDS. And Part D, the income is exempt and therefore you don't do TDS. And there are some 28 or 38 items are listed in the rule, where under which these items are exempt and you are actually not required to obtain 15CB because income is not chargeable to tax in India. Now, Part A is fine, transaction is very small. Part B, I have 197.1, it's fine. Part C and Part D are the sensitive parts as far as 15CB is concerned. I would believe the first thing, please do not issue certificate without verifying the transaction, which is a nature of services or a nature of transaction, and the underlying documents. Also, do some common sense working on the internet to find out about that supplier, about his background, about his any India connections, about his establishments in India, because in majority of the cases they give you certain declarations without verifying the facts. Say for example, the non-resident supplier would say that I don't have a business establishment in India, I don't have a business connection P in India. But if you go to a website, he would have branch office in Calcutta, he would have some authorized agent in Chennai, he would have some other offices in Bombay. Now, I am not saying that these 3 locations becomes a business connection or P. It may, it may not. But at least, because this is what department does. When you file your 15CB, Based on the supplier's name, officer does Google search, tries to find out some basic information, and then issues a notice to you to clarify. So before he does this, at least this 5-10 minutes background check would help you to ascertain the correct facts. Second, a transaction nature, agreement, emails, invoices, any other things, because in majority of the non-resident transaction, the invoice will say so and so amount as per agreement dated so and so. He will not say any nature in the invoice. So invoice is useless to understand the nature of the transaction. So unless I have an agreement, unless I have an underlying emails correspondence, to understand the nature of transaction, the nature of services, I may not be able to decide whether it does fall into Section 9 or a tax treaty, whichever is relevant to a transaction. A no-pay declaration. Secondly, Section 206 AA says that everybody should have a PAN, otherwise you have to do TDS at 20%. But then Rule 37 BC says that if he submits a TRC, and if he submits certain basic information, then you don't need a PAN. So again, a TRC becomes a mandate in the absence of a PAN. And therefore, to that an extent, also you should take care that you have at least some document in your hand. Now, as far as TRC is concerned, I am aware that it is not an easy document to get from a government. In India also, we have a similar law. If I need a TRC that I am a tax resident of India, I can apply to an income tax department and I get within maybe 2 weeks or 4 weeks. But in majority of the developed countries like USA, UK, Australia, you actually get after 3 months, 4 months. It's not that easy. Now, client may not be ready to wait for 4 months, that I can make payment only after 4 months after I get a TRC. So some underlying document, he would have made an application, at least you get that application copy. If he is ready to submit his acknowledgement of tax return, please submit that. If he is a company in foreign country, please get a certificate of incorporation in that country. Some document to demonstrate that he is a resident of that particular country in the absence of TRC. Because TRC would become relevant only when department issues notice for 201, only when there is a TDS assessment, tomorrow it happens, then maybe you are required to submit a formal TRC or similar document based on the SCAP's judgment. But otherwise, at least for the purpose of signing 15 CB, you need some underlying document to demonstrate that he is a tax resident of this particular country. But my only request is that please don't sign blindly, don't sign without understanding, and don't sign. I have seen certificates where people say, as per article so and so, TDS is not required to be deducted. The moment you refer article of a tax treaty, the TRC condition would get triggered. And just to give you a last example, on the commission payment to a non-resident. I have an exports agent outside India. I pay commission at 5% on the exports value on the exports made. Am I required to do a TDS? The answer is no. We have a Gujarat High Court judgment. It is now a settled position. I don't want to go into a history, but today the settled position is that I am not required to do TDS on the sales commission. But there is one slight caveat to that statement. One, many times the agreement says, or the correspondent says, that he is responsible to procure the order, he is responsible to delivery of the goods and to collect the payment. In addition to these, there are 10 items which gives a color of a marketing services. He will give me a compete information, he will give me a country information, what happens in Russia-Ukraine war, everything he will give me this information. Department will say, the payment is not for commission, payment is for marketing services. I am not saying that that role is not there. That role could be there, but it is incidental to his role of procurement of an order rather than his really primary role of market survey. And if that is because the moment it is a marketing services, it would take the color of FTS under 917 and you will have to do a TDS. The moment it is commission, It is a business income. Business income, unless there is a BE in India, TDS is not required to be deducted. Now, when you issue certificate under 15 CB, for a commission, you are only required to refer 911 that it is a business income and therefore there is no required to do TDS. Do not refer treaty. The moment you refer treaty, that presupposes two situations. One, it is taxable under the domestic tax, and second, you have a TRC. The moment it is not taxable under the domestic tax, there is no need to give a treaty. Treaty cannot create a charge. Treaty can only avoid double taxation. If the amount is not taxable under domestic tax, it cannot be taxable under a treaty. If it is taxable under a domestic tax, it can obligate the charging provision for under the treaty, but it cannot create a charge. And therefore, please do not refer treaty articles without understanding the implication, because unnecessarily it will increase the implication for the purpose of the compliance under 15C and your obligation as chartered accountant. Thank you.
Thank you so much, Advocate Dhinal, sir, for your insightful session. At this instance, we would like to felicitate the dignitaries on the dais at the hands of our eminent speaker. Sir, may I please request you to present Advocate Bharat Jani, sir, with a memento. Followed by Advocate Ramesh Trivedi. Advocate Amit Soni. And Advocate Nitin Vadodaria. Thank you so much, sir. The sixth technical session is about to begin, and hence I request everyone to kindly be seated.